Okay, class, in this lesson, we're going to talk about what's involved in purchasing a home, and we're going to learn to estimate closing costs. We're going to learn to calculate monthly payments for a fixed rate mortgage as well as monthly payments for an adjustable rate mortgage. So let's go ahead and get started with some background. All right, so here are some things to consider, right? So once you have, let's say you're looking for a home and you apply for a mortgage and you get approved, obviously it's a very exciting time in your life and you are definitely a big step closer to home ownership. But before you step into that, you want to make sure that you start thinking and take into consideration the following. So one of the things is obviously the cost of the home. What is going to cost you to purchase this home? And what are you going to need to do to make a down payment if that is required? You also want to consider where your home is going to be located, how many rooms you want to have in your home, the size of the property that you're going to own, the condition of the house. Do you want something that's new? Do you want something that's been previously built, or do you want something much older than that? And then you also want to take into account the condition of the house, okay? One of the things when you take into condition of the house is certain parts of the home that you should be aware of that requires a certain type of maintenance. So for example, your heating and cooling system, if it has one, you're going to need to know that those systems typically last 20 to 25 years. And so if a house has not had that upgraded or replaced within the last 20 or 25 years, then you're going to want to take into consideration the cost of that. Those are fairly expensive, and so you want to take into account for that, as well as the roof of the home. If a roof has not been replaced in the last 10 or 15 years, chances are once you take ownership of the home, you're going to have to make a significant repair to the roof, and that's a significant investment. Okay, and then the other thing you want to take into account is what is the approximate cost of running the house, right? On a day-to-day basis, you're always going to have electricity, gas, water running through, and there are monthly costs associated with that. Okay, now when it comes to costs, they fall into two main categories. One is called the recurring costs, and these are costs that occur on a regular basis. For example, your mortgage payment, you're going to have to do that every month. Your insurance payment, most likely every month, although that could be once a year. And then your property tax. Again, that could be once a year as well, unless that's included as part of your mortgage payment to the bank. And then the other category is called non-recurring, and these are one-time costs, right? So these are moving and closing costs, repairs of the heating, cooling system, or repair to your roof. Those are some examples of non-recurring one-time costs. Okay, so what is closing? Okay, closing in general is a meeting that's attended by you, the seller, your attorneys and their attorneys, and then a representative of the lending institution. Okay, now that may not always be the case. Sometimes it's just you and your attorney, and all of the other necessary paperwork that the other parties need to complete have already been completed, and so it's just a smaller party. At the closing, this is when the official sale takes place, and assuming that all the documents are signed, you will take possession of the keys to the home. Now, when you go to closing, you as the buyer is responsible for paying closing costs. And here are some of the most common non-recurring closing costs, okay? So number one is the earnest money deposit or good faith deposit. This is the money that you pay to the seller, and you actually place it in escrow to indicate to the seller that you are serious about buying this home. It's sort of it's a way of showing commitment to purchasing the home. Then there's also attorney's fees, and these are fees paid to the attorney in return for them representing you at closing. And then there's also origination fees, and this is money paid to the lending institution for the paperwork involved in the loan application process. Title is the legal claim of property ownership, and it is common practice that before property can change hands, a title search is conducted. And this is done to make sure that the seller does actually hold title to the property being sold. Okay, another term is points, and these are extra fees charged by the lending institution for the use of their money. Each point is equivalent to 1% of the loan amount, and there are two types of points. Similar to origination fees, origination points are collected from the buyer as a means of paying for the loan application process. Okay, and then the other type of points is called discount points, and these reduce the interest rate of the loan. They generally lower the interest rate about 1/4% on a fixed rate mortgage and a 3/8% or 0.375% on an adjustable rate mortgage. So another way that, or another term or phrase that you might hear out in the industry is called rate buy down, and that's a way to pay to lower the interest rate. Of course, these percentages vary depending on who you go with, whether it's a bank or a mortgage company. There are different rates that they will account for when you buy them down. Okay, prepaid interest. These are mortgage interests. It's not like paying rent. Excuse me. What I meant was it's not paid like rent. Rent is paid ahead of time, and let me go ahead and fix this. Rent is paid ahead of time when you live in the home, but with a mortgage payment, it actually begins, or the mortgage interest is paid in arrears. What that means is that, excuse me, interest starts accruing or building at the beginning of each month and continues throughout the month. And so when you make your mortgage payment, you're essentially paying the interest that has built up on money borrowed during the month that just passed, okay, except for at closing. Go ahead and correct this here. Okay, prepaid interest at the closing is the amount of mortgage interest due to cover time from the closing date to when the first mortgage payment is due, okay? So you'll see later on in one of the examples on how we calculate prepaid interest. And then the last term is transfer tax, and this is a fee that is charged for the transfer of title from the seller to the buyer, okay? So the whole point of all of these terms is that when you go to closing, don't be surprised when you start signing paperwork that you see all of these different fees. This is very typical, but it's also very important for you to understand what they are before you go into signing so that you're not caught by surprise. Okay, so let's go ahead and start with example 1. Let's suppose that Cassie and Donovan are buying a $600,000 home. They've been approved for a 3.75 APR mortgage. They are making a 15% down payment, and they're going to be closing on September 6th. And the question is, how much should they expect to pay in prepaid interest at the closing? Okay, so the key thing here to recognize is that they're making a 15% down payment, which means what they're really borrowing is 85% of 600,000, okay? So we're going to take 600,000 and we're going to multiply that by 1 minus 0.15, and that's going to give us $510,000. Okay, so that's what they're really borrowing, which means then we're going to take the 510,000 and we're going to multiply that by 3.75% or 0.0375 to determine how much interest that's going to cost. And that works out to $19,125. And then we're going to take that and divide that by 365 days. okay? 365 days in a year, because we want to know how much interest they're going to be paying each day. And that works out to $52.40, okay? And if you take a look at the date of closing, September 6th, okay, and since their first payment won't take place until October 1st, we have to calculate how many days there are from closing date till the end of the month. And September has 30 days, so then 30 minus 6 would give us 24 days of interest that they would have to pay. So then we would take this 52, and we're going to multiply this by 24 days, and our prepaid interest is going to work out to $1,257.60. Okay, so that's how much they should expect to pay at closing. Okay, let's go ahead and move on to example number 2. Here we have Cassie and Donovan know, this is related to example 1, they know that they will have to bring their checkbook to closing. What might they expect to pay in total at the closing? Okay, now the rule of thumb is that you can expect closing costs to run from 2 to 6% of the purchase price. Okay, so then we would take 600,000, and we're going to multiply that by 2%. That's going to work out to $12,000. And then we could also take 600,000 and multiply that by 6%, and that's going to work out to 36,000. And so Cassie and Donovan should expect closing costs to run between $12,000 and $36,000. Okay, all right, let's go ahead and move on to example 3. Naomi has been approved for a $300,000 15-year mortgage with an APR of 3.98%. How much of her first month payment will go to interest and principal? Okay, so the first thing we want to do is find out how much her monthly payment is going to be. I've shown you how to do this before using a formula, but the best way and the easiest way is to go to a spreadsheet to calculate this. So let's go ahead and do that. We're going to say that our payment amount monthly mortgage is going to be equal to the payment function, and the interest rate was 3.98%. So we're going to take 3.98%. We're going to divide that by 12. And this is a 15-year mortgage, so that's going to be 180 months. And she is borrowing $300,000. So we're going to put in a negative 300,000, and that payment comes out to $22.16.06. Okay. So payment, I'm going to say monthly payment is $2,216.06. Okay, now we want to know, we need to separate this out. Obviously, this monthly payment consists of interest and principal. Okay, so to find the interest payment, we're going to take this following equation. Interest is equal to the principal amount times the rate divided by 1,200. Okay, now why 1,200? We have to take the rate and divide it by 12 months, but because the rate is in percentage, we have to divide this by 100, hence 1,200. Okay, so our principal amount is 300,000. We're going to multiply this by 3.98 divided by 1,200. Okay, and punching this into the calculator, we would get $995. Okay, so $995 represents interest. Okay, and then we would subtract that $995 from $2,216.06, and that gives us $1,221.06 that goes towards principal. Okay, so interest and principal. Okay, let's go ahead and move on to our last example. But before we do that, I wanted to explain what an adjustable rate mortgage is, and they are typically referred to as ARM, okay? So with an adjustable rate mortgage, lenders typically quote you what's called an initial rate that stays in effect for a certain period of time, and then after that period, the rate can adjust, okay? So as an example, one of the common ARM out there is a 3-1 ARM, and that 3 and 1 represents the fact that the first 3 years is a fixed rate, and then every year after that can adjust, okay? So let's take a look at a particular example. We have Giselle and Christian are considering a 30-year 3-1 ARM for the purchase of a new home. They're looking to borrow $600,000 and were quoted an APR of 1.9% fixed, and then adjusts 1% after that, okay? So the question is, what is the difference in monthly payment for the first 3 years versus the fourth year? Okay, so the first thing we want to do is find out what the monthly payment is within the fixed period, which is that first 3 years, okay? So let's go ahead and go to our spreadsheet. Okay, so the home price was $600,000. Let's go ahead and delete this. The interest rate fixed was 1.9%, and they are borrowing for 30 years, so this is going to be 360 months, okay? So our mortgage, monthly mortgage, we're going to use the payment function again. That's going to be the interest rate divided by 12, and then the term, which is 360, and the amount is going to be $600,000, okay? So the monthly payment is going to be $2,187.83. So let's go ahead and make a note of that. So fixed period, our monthly amount is $2,187.83. Okay, so to figure out the monthly payment, once the interest rate adjusts, we want to know what the principal amount is at the end of the 3-year period. Okay, so we're going to need to go back to the spreadsheet. There are a couple ways to do this. I'm going to show you how to do this systematically on the spreadsheet rather than using a formula, so you can see how this really works, okay? So if we fill out this sheet, we're going to start with the beginning balance, which is going to be equal to the $600,000. Our monthly mortgage amount is going to equal what we calculated in cell E4, okay? Now I'm going to go back into this cell, and I'm going to lock in this cell because I'm going to make a copy down the spreadsheet, okay? My interest is going to be equal to the principal amount times the rate divided by 1,200. So we did this in an early example. Okay, so we're going to go ahead and calculate equal to the principal, which is 600,000, and that's going to be multiplied by the rate, 1.9%, divided by 1,200. Okay, and that cannot be right. It should be divided by 12. Because it's already taken into account the percentage. There we go, $950. And then the principal is going to be the monthly payment minus the interest. Okay, and then our ending balance is going to be equal to the beginning balance minus the principal amount. Okay, so you could see at the end of month 1, the principal only went down by $1,237.83. The balance of the monthly mortgage payment that you made went towards interest, right? So that's the money that the lender is making off of you. Okay, so then the beginning balance for month 2 is going to equal the ending balance of month 1. My monthly mortgage payment is still the same, so I'm going to copy that down. My interest will be calculated based on the beginning balance, so I'm going to just copy that down. And I forgot to lock in a cell here. This is C4, needs to be locked in here. Now we can copy that down. Okay, you notice how the interest comes down a little bit, my principal increases a little bit, and then my beginning balance or ending balance will continue to go down by the principal amount. Okay, and so this ending balance is what we are looking for, but we want to know what that is at the end of 3 years or 36 months. So now we're going to go ahead and copy all of these cells down to 36 months. Let's go down to 36 here, paste it. All right, so here is our ending balance, $554,180.82. Okay, so now we can use the payment function again to calculate what our monthly payment is going to be with a variable interest, which now increases by 1%. Okay, so if you recall, the interest rate was 1.9%. So now my interest rate is going to be 2.9%. We're going to divide that by 12. And the number of months left in this mortgage is going to be 30 years minus 3 years, or 27 years left. But we have to convert that to months. And so that's going to work out to 324 months. And then my balance is going to be this negative $554,180.82. Go ahead and close that off. And you'll see that our new mortgage amount is $2,468.54. Okay, so let's go ahead and write that in. So during the adjustable period for year 4, our balance, our mortgage payment is $2,468.54. Okay, so then the difference is going to be, let's go ahead and calculate this. Difference is going to be $280. Okay, so with this adjustable rate, you'll see that the monthly amount went up $280.71. Okay, hopefully that made sense. If you were not clear on any of this, please go back to the beginning of the recording and listen to it again. Thank you.